Okay, welcome to the Property Prescription. Today we've got a special guest, Tomas Turkayoglu. Thomas has been with us for how long?
For 11 years now.
11 years, long time, part of the furniture.
It's feeling like that. It's been great.
And your role within the business. Do you want to talk about that?
Yeah, so I'm one of the advice directors within Property for Doctors as well. And part of my role is to work with doctors, understand their goals and help develop strategies on how they can achieve them.
Yeah, and today we're going to talk about a $5 million portfolio that you're usually doing a lot of work on in terms of how to structure it, what it looks like, what you're telling doctors they should be doing, what they shouldn't be doing. So do you want to just elaborate on that, and how do you structure a $5 million portfolio?
Well, when looking to build a portfolio, whether it's 5 million, 10 million or above as well, first of all, we want to make sure that our doctors and clients, they're in the position that they are able to do that and do that safely as well. And we obviously want to look at a few risk mitigation elements as well. First of all, it's making sure that we have the dream home. So we have the dream home, we can see ourselves there for 10 or more years, and it's important that the debt on that is either under control or close to paid off, right? So that non-tax deductible debt. Once we're in that position, we can then look at building a $5 million portfolio. And the key part about this is also having a really strong professional team around you. So having the right wealth advisor and accountant for structuring as well. And then we fit in there for that property piece. But a $5 million portfolio has a mixture of residential assets initially. I mean, the ideal portfolio has a handful of assets, usually 3-4 residential assets that we're looking at. And it's also complemented by advice from the wealth planner, where we're looking at other asset classes.
You definitely need both, don't you, sitting in a doctor's portfolio? So, you know, over the years, we've been the property solution for them, and we see a number of different sort of case studies, and I'm sure you've seen a lot of hairy sort of case studies that have come through that you've met with. And what are doctors saying at the moment? There's a lot of global uncertainty out there. There's a lot of questionable activity in terms of what's happening to sort of interest rates and capital gains tax. What are doctors, when you're going meeting them every month, what are they saying and doing?
There is a lot of uncertainty around the world as well, and whether it's geopolitically or some of the changes the government are looking at in terms of capital gains tax and negative gearing as well. And that's probably the main comments that we're seeing from the doctors that we're working with as well. And what we're reminding everyone is just to take a bit of a step back and a breather and stick to the key fundamentals, and that part's important as well.
And the fundamentals are, so rental growth, we talk about that a lot with our doctors. Why is that so important?
Well, rental growth is one of the key indicators for price growth. So when you see 12 to 36 months of rental growth in a market, and among other factors, then that would usually lead into price growth as well. But in terms of a doctor's portfolio, it's about finding that balance between the growth and the yield. Because if our net yield is too low, it puts a lot of strain on the growth of the asset and then also the cash flow as well. And it's about making sure that we can balance each of those in the portfolio too. And
a lot of the stuff that we're seeing coming across our books is, you know, the larger residential home where the doctor wants to go and buy in, you know, an eastern suburb in Melbourne or in Sydney or in Brisbane. And we're seeing a lot of debt going on to the larger principal place of residence. And do you want to just talk and elaborate on that in terms of if they take on too much debt, usually what happens?
We do see that quite frequently. I was actually met with a doctor earlier this week, and we were looking at the upgrader strategy. So how can we upgrade their principal home? And another key part of that is making sure that you're in a safe position to be able to do so. Because when it comes to the banks, lending capacity is everything. And we want to make sure that we're not allocating too much of that lending capacity or taking on too much debt on that principal home. Otherwise, then it restricts you from investing in other assets as well.
You've been working with doctors for, almost 10, 11 years now.
Yep.
What are some of the mistakes that you see that come across your desk in terms of dealing with some doctors, young trainee doctors, you know, all the way up to surgeons, orthopedic surgeons, ophthalmologists? What are some of the mistakes that you've seen over your time?
There's a few things that we've seen there, and sometimes, more often than not, it's about not getting the right advice and not surrounding yourselves with the right team as well. And then, as we touched on before, it's taking on too much debt for the principal home. And it doesn't mean that you can't buy the principal home. Sometimes it's better to slow things down, maybe buy the right assets initially, and then look to upgrade the principal home at a later time.
And a $5 million portfolio, how many residential assets are usually sitting in there? Are they trading? Are they foundation? What's the mix that when you're dealing with them look like?
With the 5 mil portfolio, there's usually around 3 to 5 residential assets, and that's a mixture of what we call foundation, which is a longer term passive hold in the portfolio, growth focused. And then we also have trading assets. And trading assets is more based on timing, but that helps us pay down debt on the portfolio as well. And we're still managing that net yield and the growth in the portfolio.
Yeah, it's really important they have a great wealth advisor, because we're usually only 50% of the overall wealth plan with the property related holdings, and the accounting side as well. Often a lot of mistakes we've seen over the years is having the incorrect structures in place. So just talk to us a little bit about that in terms of what you've seen.
And that's the thing, and it's about getting the right advice at the right time as well. So some doctors that we've met with have come in with existing assets. They could have 5 existing assets under the wrong advice and the wrong structures, and also not the right assets as well. And so what we've had to do is divest some of those assets if they're not in the right market or it's not the right time, and then making sure that they're getting that right accounting advice. And we can't, I can't give the accounting advice on that side, but it's making sure they're speaking to the right people, and then also choosing the right assets as well.
Thomas, what's the one thing that doctors need to understand about the current property market at the moment that you're seeing?
With the current market, yes, there is uncertainty, and whether it's the right time to buy depends on a person's specific circumstances. But the uncertainty also breeds opportunity, and there are definitely certain markets out there right now that are showing value and showing more value now than they have over the last 10 years. But at the same case, there's also other markets out there that may be fully priced that you should be avoiding as well. But all I would say is sticking to the key fundamentals of following the data of the markets that have the affordability and the demand, making sure that data fits within the right strategy. If you're building a 5 million portfolio or paying down debt on the portfolio, and choosing the right assets and having the right advisors around you to make sure you've got the confidence to make those decisions as well.
Yeah, you're absolutely right. There's no one strategy that suits every single doctor. And all the doctors that we've met over obviously 12, 13 years, they've all got different strategies. They're all at different life stages. So it's more around understanding their position and then creating a strategy around that. And we've seen a number over the years. So the current trends that you're seeing at the moment in terms of markets that are showing value and possibly markets to stay away from, what are you seeing on the ground?
So if we look around the country at the moment, every market is segmented and it's operating slightly differently. We've seen aggressive price growth across the country in majority of housing markets over the last 5 to 7 years, coming from a low interest rate environment and then low supply, high demand. We see the increase from prices that's followed from that as well. We're seeing value for the first time in over a decade for the business very long time is Melbourne. Melbourne, from a data point of view, is as good now as we've seen since the early 1990s.
Yeah, 96 looking at the cycles, and it's the cheapest that we've seen it since 2018 looking at the data. Prices
have been flat up until recently, but it's a very two-speed market. The higher point of the market is still interest rate sensitive and is a little bit slower. There's more value sort of below that $1.3 million in the right areas as well.
Yeah, it's funny with our Sydney doctors, because the affordability constraints and the cost of living in terms of what it costs you to buy your house in Sydney are so high. And if you're a young doctor, to buy a really good quality unit in Double Bay, you're looking at sort of $1.5 to $2 million. So our Sydney doctors often are great investors and they're building fairly large residential portfolios with us. But Melbourne and Adelaide doctors are a little bit different in terms of their mindset. So each of our doctors positioned around the country are a little bit more aggressive than others. What do you say to doctors that want to go and do a development as their first investment?
Often it depends on their specific circumstance, if they can. But often for a first investment, it's not about taking on risk. It's following the data, buying in the right market and let that market do the heavy lifting for you as well. But if you are going down the development path, and there's a lot involved in that, particularly if someone doesn't have the experience or this is their first time as well. And it's about looking at the costing. What we've seen running some feasibilities around the country is it's quite challenging, particularly for a small development to stack up on the feasibility. Right? So it's a bit of a risk to take that on at this point in time.
And with some of our doctors, in terms of, I think a number of the discussions you're having with doctors is good debt versus bad debt. And getting their heads around in terms of understanding what good and bad debt is. Do you want to sort of elaborate on that? Because you're having a number of these discussions with doctors at the moment?
Looking between the good and the bad debt, it's also about the tax deductible and the non-tax deductible debt as well on that side. And you could say, bad debt could also be car loans and other loans of that nature or personal loans. And it's about, again, getting the right structure and advice from the financier and from your accountant as well. But when we look at our principal home debt being non-deductible, we want to try and keep that as low as possible if we can. And then we have our investment debt, which is deductible, and we could run that a little bit higher as well.
And what's the one mistake? I want one mistake out of you today that you wish more medical professionals would avoid. What's one?
Get the right advice first before making decisions.
Absolutely. Try and get in as early as possible. Risk mitigate it.
Yeah.
So
when it comes down to timing, there's never the right time for anything. Everyone's strategy is different. But looking at your own personal circumstances and the position that you're in, and you can make some great decisions.
All right, we'll leave it there. And thanks for listening to Property Prescription.
Perfect. Thanks for having me.